Here we go. Let's get started this morning. How you guys doing? Happy to have everybody. My name is Lan Turner. Those of you don't know who I am, former instructor at the Chicago Mercantile Exchange Board of Trades Education Center. Once again, that's kind of my feather in the cap. Currently an instructor of finance at Utah Tech University. And this is our lab for the university classes. Now, our options class just finished on Friday, but that does not mean that the learning stops. That means that we now come to the lab and we spend more time in the lab learning and practicing what it is that we learned in class. So welcome, everybody. Glad to have you. We've also got a group of people who enjoy coming and hanging out with us from the YouTube community as well. And those people are obviously welcome, welcome, welcome. Everyone is welcome. Just because this is a lab for the university does not mean that you can't come and join. You certainly can. Everybody is welcome. So what we're doing in these classes is we're getting introduced to the financial markets, primarily stocks, futures, and options. Okay. So we started, this is class number what? 54, 55, something like that. This is the lab number 55 this semester. And we've got one more class in this semester. So if I come and pull up our class outline, you can see that we're in week 4, starting November 20th, no university. So there's no university this week. And then I haven't updated this table yet to show that next week is our last class for the university. Oh my goodness, there goes the market. Taking off 2 minutes before the bell, dropping like a rock, broke through that VWAP right there. Man alive, it's flushing. This S&P's coming down and bouncing around the VWAP. What's interesting is these markets all kind of travel the same, and the VWAP on it is a different location on each one, but yet the trend itself is the same or similar. When they're not doing the same thing, then we have to be cautious, because these three markets right here up in the upper left-hand corner, that's the S&P 500. We have the Dow in the upper right-hand corner. We have the NASDAQ down in the bottom right corner, and we have the Russell in the bottom left corner. Now, the Russell does a little bit different, but we expect the S&P, the Dow, and the NASDAQ to do kind of the same thing. I call it porpoising, like porpoises or dolphins in the waves. They all kind of do the same thing. Not that they're exactly the same, because they do have different trends and they do a little bit different things, but nonetheless, we do expect the overall longer term trend to be basically the same. So I like to trade the lagger. So if one is slow to move, 2 have gone, one's slow to go. That slow one's the one that I like to take. It usually goes 2. But these things all have the VWAP, volume weighted average price, turned on. And the trends are the same, but the VWAPs are different. So they affect the markets a little bit different. There's the opening bell. And the markets go crazy on the opening bell. Now, why do the markets go crazy on the opening bell? Now, we're in the futures market where we're trading a 23-hour market, right? Market trades for 23 hours a day. It only closes for 1 hour. And that's in the afternoon, like 3 o'clock in the afternoon. So this morning session thing is really nothing for the futures market. The futures market, of course, traded out of Chicago. The New York Stock Exchange is traded, of course, out of New York. 2 different exchanges, but we do trade the stock indexes in the futures market out of Chicago. So out of Chicago, you can trade the New York Stock Exchange, or the stock indexes anyway. We have different rules. No pattern day trading rules over here. So you can trade at a oh, wow. Look at that NASDAQ. Flushed down and rallied back up. The Dow flushing down just before the bell, rallying back. Look how hard that NASDAQ's going up there, getting ready to test that previous high. People are excited about the NASDAQ. Woo, look at it go. Lan, why aren't you trading the NASDAQ? Oh my gosh. Oh my. Go ahead. If you want to jump into this fray, be my guest. It's going a little bit crazy. Apologize. I'm losing my voice already. Got my tea. Boy, look at it go. Does that mean it's bullish? Good. Could mean that. What this is all night long. People come home, mommy and daddy. Actually, this is Monday. So all weekend long, people were excited to trade. They thinking the market was going to be bullish or bearish, and they're placing their orders in the middle of the night, placing them orders on the weekend. And so these are all those orders that sit in a queue waiting to be filled. And the big clearing firms, they come in and they have all these orders build up. And when the opening bell opens, they go and they fill all these orders, whether bullish or bearish. Doesn't make a difference. It's just, was there a whole bunch of orders to be filled bullish? Was there a whole bunch of orders to be filled bearish? And they just fill them all and match them all up. And as that happens, these markets go a little bit crazy because there's more than one clearing firm, and they have to all match up. They can match up within the same clearing firm, or they can go out and, go to the dealing desk and match these orders all up with other clearing firms. There's just a lot of action going on right now on the opening bell. These are all the orders that are being filled from people who placed their orders in the middle of the night or in the middle of the weekend. And that's why the market runs crazy in the first thing in the morning. It's not necessarily traders like you and me sitting here trading. It's just all these clearing firms filling all these orders. And so the markets go a little bit crazy. And if people were bullish on the market over the weekend and thinking the market was going to rally and they wanted to get into these big markets and make up these index funds, they put in all these buy orders. So there's lots of people who had to sell, right? They sold all their orders, and so they flushed the markets out first. The market come flushing down as they sold out all the orders of people that wanted to sell, and then they fill all the orders that people want to buy. But there's more buyers than sellers, so the market starts to go up. And so that's why you have this flush and this rally and all this movement that goes on first thing in the morning. Now, it's fun to watch, and sometimes it is an indication or indicative of which direction the market goes after all that calms down and settles out. Because if lots of people were bullish in the middle of the night or in the weekend, and all those orders come in and it pushes the market higher, that kind of intrigues the traders and gives them a reason to think that the market's going to be bullish, and it kind of gives us a bullish incentive to rise in price, right? So that's what happens. That's how this works. And as the market kind of slows down and all those orders, it usually takes, how depends on for every buyer, there's got to be a seller. So they got to match those things up. And if there's more buyers than sellers, they have to kind of wait until they can get the sellers that want to come in from people who wanted to buy on the open, sell on the close, buy on the open, sell on the open. So they're matching those up. Sometimes that takes 10, 15 minutes. Sometimes it's over in the first 5 minutes. But, you have to kind of watch and see when that transition occurs from when they're filling all those orders and matching all those orders up to when traders are jumping in and trying to get in and start deciding the trend. One thing we like to do is we like to look at the economic calendar because that's important to us. It always helps us get an idea of market direction and whether there's going to be a lot of activity. So this is our news events that are going on here. And 8 o'clock a.m., we had CB leading index. I got to make sure I'm on the right UTC. I was on the wrong UTC, and we missed a big move in the market. 3-month bills, 9:30, 8 o'clock. We got leading index. So in 25 minutes, we've got one. Slovakia's unemployment rate dropped. I'm sure that this little economic calendar thought that was important to me to know. 6-month bill auction comes up at 9:30 and then 11 a.m. 20-year bond. So those might move the market a little bit. So we'll probably get a little bit of action out of them around 8, 9:30, 9:30, 11. Not that great because it's not the high impact. If we just turn on high impact, let's just go to second impact. 6:30, 8 o'clock, existing home sales. Hey, wait, is that today? How come that refreshed? Because we had it on here. So we want to see twos. There's twos for today. So 6:30, 8 o'clock, we're going to existing home sales. That'll move the market. Existing home sales at 8, 12 o'clock, FOMC minutes. So the Fed's speaking at noon. So be mindful of that. So the only thing we got is Fed's. That's 12 o'clock noon. That's going to be a big deal. So impact is going to be high. So there we go. Okay, 8 o'clock and 12 o'clock today. That's our big news. Okay, look at these markets go. Let's bring these things down to size. Let's draw a dollar calculator. Look at the Russell. It's going just exactly the opposite of the S&P. Now remember, we talked about that. The S&P, the Dow, and the NASDAQ, they all kind of go the same. The Russell, we call him Cousin Russell down there. He likes to do his own thing. Cousin Russell's made up of a whole bunch of small cap stocks. So the S&P large cap, Dow large cap, NASDAQ large cap stocks. So we're watching these things. We're looking for an opportunity to get in. Don't get hasty. I mean, it's only the first 5 minutes of the day. We got 7 hours to trade, right? No reason to get crazy. Get crazy on the opening bell. Can you get crazy on the opening bell? Absolutely, if you want to. Let me show you how much money that was from let's just say from the bottom of this yellow bar to the top where it's trading now. That's $295. $295 on a $1,000 investment. That's pretty good. Let's see this NASDAQ. It's a bigger market. That's $1,670 on the NASDAQ. Woo! That's a big move for $1,000 investment. How about the Russell? That's a $390 move. So it's a little bit safer to jump into on this fray. That's $425 on the S&P, again, for a $1,000 investment. Now we work on margin, so it's a margin investment, but nonetheless, it is a $1,000 you have to put into the market to trade these markets. All right, we're getting a little flag formation up here. This is called a flag formation where you get higher highs and higher lows, and now we're getting lower highs and higher lows. That's a flag formation. All right, a flag gives you the opportunity to get into this trend. Now we've got the bulls and bears turned on, so we got a bullish arrow. Oh, look at Cousin Russell. He's coming in. Cousin Russell. So that's a buy signal if you want to take it. But we're kind of running out of steam. Oftentimes this market will sweep up really hard with all those orders that get filled first thing in the morning, right? Because they're filling all the buy orders from over the weekend. And so it'll come up and it'll start to get a little bit slow, and then it'll drift and come back down. Sweep out all the lows, sweep out all the highs. That's what they call that, the sweep. So we got a high in here that's important to us. We got a low in here that's important to us. And it broke out above the high. It's flagging. That's what that's called. It's called flagging. There's another little flag right here. You can see. Oh, getting the wrong tool. Sorry about that. Over here on the S&P, we had a little flag. Again, a flag, of course, is where you're getting higher lows and lower highs. In an uptrend, right? Or in a downtrend. It doesn't matter. Here's a little flag right here. So if you're looking for opportunities to get into a big running market and you're like, well, where do I get in? Where do I get in? It's going too fast, too far, too fast. We wait for these little flag formations, these little locations where we're getting higher highs and higher lows. And then we get a lower high and a higher low, just like that. And when it breaks out, that's a rally to go high, go long once again. Now, remember up here, I get a little nervous after 1, 2, 3, 4, 5, 6, 7, 8 big, long, higher low bars. And we start losing our momentum up there. That's why I wasn't real anxious to jump on right there. We got what we call a clearing bar. This is a bar that has a topping tail that goes above the previous bar and a bottoming tail that goes below the previous low. So it breaks both the highs and the lows. All right. I call that a clearing bar. It clears out all the stops, stop hunting. They clear out all the stops to the upside, clears out all the stops to the downside. And usually the first bar, the first flat bottom or flat top bar after a clearing bar indicates the new market trend because it wipes everybody out, clears the board, and then everybody has to decide where they want to get in, which direction they want to go. So a clearing bar takes everybody out of the market, wipes everybody out. And then all the new traders jump in, decide which direction they think the market's going to go, and that's usually the new trend. So we're seeing it fall right here off of these green dots. So green dots are the average true range, and I got them a little aggressive today. Usually I have them just set to 1 and 1. But I've tightened them up a little bit. I like to tighten them up a little bit once in a while. That's on the 0.08 at this point, as you can see. So that's the breaking of the green dots, the average true range. And now we'll probably see this market flush back down, maybe around to this first target point, which is right in here. And the exercise here is to try and get good at reading the market. Make your predictions, make your decisions where you think the market's going to go. based on technical analysis, these markets move through waves, 2 steps forward, 1 step back, 2 steps forward, 1 step back. And they just generally have one up for every down. And they'll have one up for every down. The one thing we don't know is how big each up or each down is going to be. Sometimes it's big, sometimes it's small, and we base that, primarily on that average true range. So whatever side the average true range is on. So if it's the market price, the ticks are below the little green dots, we're anticipating a downtrend. If the little ticks are above the green dots, we're anticipating a continuation of the uptrend. So it's the breaking of those little green dots. Sometimes I have them turned to yellow. It doesn't matter. You can have them whatever color you want, but it's the breaking of those dots that kind of helps us identify whether the market's bullish or bearish on a short-term trend. And then we use another tool, and you can use a series of tools. You can use moving averages. You can use a number of different tools. I like the bulls and bears or the moving averages, and they tell you the overall longer-term trend. Now, the bulls and bears is based on Fibonacci and Elliott wave. It's a little bit more advanced tool as opposed to just a single or a simple moving average system. So that's what we're looking at on that red arrow. Now, red arrow is telling you the market has changed to bullish or changed to bearish. We don't actually use those as buy-sell signals, not for the most part. You certainly can. There's nothing wrong with it. You certainly can. But we generally go with a little bit more aggressive tool, which is the yellow arrows. And the little bit more aggressive tool is the one we take the signals on. So if we have a red up arrow, we only take the up yellow arrows. If we have a red down arrow, we only take the yellow down arrows. Does that make sense? So we adhere to the trend of the red arrows, and then we take the signals from those arrows. So for example, this arrow down here, it's down. So we would not take this arrow because it's going in the opposite direction of the red arrow. We would take this arrow, okay? And then we get a switch over right here. Now, if they go both on at the same time, you can take them, all right? That's the idea. If they switch at the same time and they're on top of each other, those are generally pretty good signals, and you can usually take those right there. Now, this one here came in a little early, so we said no, but now we're bullish on the Russell, so now we take up arrows on the Russell. So if we get a down arrow coming in, we won't take it because we're in a bullish market, okay? So here on the Dow, now look, this is indicative of all the orders, all the overnight orders have been filled, and now we're waiting for a new trend to ensue, right? So that market just started to kind of wander sideways. That's kind of indicative of the fact that they've cleared out all those nighttime orders, and now they're waiting for the traders to step in and decide which direction we want the market to go. Now, there's all different sizes and kinds of traders. There's traders like you and me, little tiny guys who are in here, little gnats on the, little gnats that like fruit flies. That's what we are. We're like little gnats. We're so tiny compared to the rest of the market, right? And then there's great big giants that are in here. There's guys like BlackRock and Main Street and Fidelity and great big huge firms like that, Goldman Sachs, and they've got traders, and then of course there's lots of hedge funds that like to trade, prop firms. So there's lots of different groups out there that like to trade, and those are some big boys. They have millions and millions and sometimes even billions of dollars that they push these markets around with. And us as little gnats, all we can do is wait. We wait for one of those big boys to decide they want to start buying. And they don't just lump in a whole bunch of shares. They don't just go in and say, oh, I want to buy $500 million worth of the Dow. Throw it all in there. They don't do that. They slowly accumulate one direction or the other, and then they slowly distribute one direction or the other. So they get in slowly, they get out slowly, and they just add over a period of time. Then they get out over a period of time. And they just kind of slowly move into the markets, slowly move out of the markets. And what that does, it causes the trends, okay? So as they're moving in, they're buying. For every buyer, there's got to be a seller. So they got to wait for sellers to take their positions. And when they're big like that, they got to find sellers. So there's kind of little games and tricks they use to get people to buy and sell the markets. And then that's how they get in and out of markets. That's how they get big positions built up. And sometimes they sit on the sidelines just like everyone else. We don't know. Let's wait and see. Let's be smart about this. And that's why I'll oftentimes tell you, we'll come and trade these morning bells. They're kind of fun. I mean, it's exciting. It's like a game, right? You're trying to get in on these moves and it's fun and you can take big risks and you can ride them and the rewards are big if you did it right, you know. But most of the time, the morning bell, most big players kind of sit and watch too. They kind of sit out. They know that these are just orders being filled over the night. They don't get too excited about it because they understand the game. And then what they do is they wait, and usually kind of around 9, 10 o'clock my time. I'm in mountain time, so 9, 10, 11 o'clock in the morning, um, or 10, 10, 11, 12 o'clock, back east, they'll start doing their little bit of buying and selling based on their strategy. That's why I say if we come in here and we try to trade this first thing in the morning and we get down a little bit because we get bumped out or whipsawed, come back, go away, walk away. You got to learn to walk away, come back in a couple hours when those boys are starting to trade, and the market will be a little bit smoother, a little bit more trendy, a little bit easier to get into a trend, and you can recover your losses or even, make a little money in the afternoon sessions or in the late morning sessions. Those are usually for me the best times. So you'll see me come in here and I'll trade with you guys, and I think it's fun to be here on the opening bell. It's exciting to watch the markets move like this. But if I get down a little bit, like I did on Friday, I got down close to $500 on Friday, right? And we kind of got frustrated with that Dow because it did this exact thing. We got this big run in anticipation. I got a little anxious, wanted to take a position. I took a position and the market just never moved. I took another position and it just never went. I took another position and it just never went. And after 3 positions, I took one more because I had my 3 strikes and you're out land. But I took one more, took a 4th position, and it lost 2, and I gave up. That was it. But then I came back 2 hours later. I try not to do that because it's not on screen. You guys don't get to see it, but it's fun for me. I like to do it. I like to come back in a couple hours and practice my strategies too. I'm always practicing. And then, got in there. It was pretty simple little process. The market was trending nicely, and I put a couple positions in, brought that thing back to green, and then that was all there was to it. All right. So just be careful and cautious here in the morning. Realize that it's not the most optimal time to be trading. It's a time when you can make a lot of money really fast if you can get in on a breakout. So here's a little breakout trying to occur here on the NASDAQ to the upside. We're still in a red bullish trend. We do have a yellow arrow. If we get a yellow arrow right here, we could take another long position. We could anticipate the yellow. Now there's 3 locations. Let's bring this full screen. I'll teach you another little lesson here. I know we're just taking off like a rocket ship here, and I haven't come and said hi to everybody yet. Give me a second. We got several locations here. We can get in right here. Let's say we get in with 1 contract. If we get in with 1 contract, we only have 1 location to put our stop, 1 price bar back. That's where I would put my stop. If we get in with 2 contracts, we can put them both at 1 price bar back, or we can put one at 1 price bar back and we can put the other one down at the low of the market. So it depends on how aggressive you want to be with your stops. Me, in the beginning in the morning session, I'm generally pretty aggressive with my stops. I don't generally want to get in. We'll do a little scalp and trail here. See if the market wants to pop up a little bit. But we're breaking this little trend, right? We got the red arrow. So this is our signal. We got the red arrow up. We've got the yellow arrow down, so we don't take the downside. The next arrow, if it closes above that green line, which it looks like it wants to do, I just anticipated that it was going to do that. Close above that green line, then it should give us an arrow to the upside. But it's got to wait for that bar to close. And then we got 12 seconds on it. So it went up there, took out our stop. I put it just inside of that 15,980, as that becomes a strong area of resistance. So that's a scalp. Okay, a scalp is where you just take a quick one off. So that was $155. We took that scalp off. I got in a little bit late. I could have got in a little bit earlier, but we're okay. Now we're looking for it to break above that high. If it breaks above that high, we'll continue up. And I was saying that there's multiple places you can put your stops depending on how many contracts you go in with. I went in with 2 contracts there, so we could do a scalp and trail, which means we take the first one off, covers our expenses. The second one, we'll just leave down here a little bit more and let this market move a little bit, not get so aggressive with it. And our limit order, we can pull it out. We can go at a different location, either out here farther, let this market run, see how far it wants to go, or we can be a little bit more aggressive and put it right here at this next 16,000 location, which is also an area of resistance. Okay. And you'll notice I put it inside of the 16,000, so it doesn't have to go up and touch 16,000. It just has to go up and test it. If it goes up and test it, we take that limit off, and that right there says that would be a $545 move. So if we can get that thing to continue up, you'll notice that my stop order is automatically moving. I got it set to go one price bar back. So as long as it's making higher lows, it'll just continue to trail up. It's still in a losing trade at this point. If the market flushes back down, we'll still lose money because my stop is behind my entry point. Even though I'm showing an open profit of $395, I'm still in a losing trade. Technically in a losing trade because my stop is not brought up to my break-even point. Now, the computer is the one that's trading this. I've turned it over to the computer. I don't have anything to say about it now. I do. I mean, I can always intervene. I can say, oh, I've got enough money and boom, take it right now. Right? So, but we're going to see if it won't go up a little bit more. Give us one more bar push up there. Test that 16,000. If it tests that 16,000, we'll take that off. Our daily goal is $500. So if we get a little nervous, you can always grab your stop. It just moved to break even. See that? So we can grab our stop and say, well, if it pulls back, we'll just get out with this much money and take it right now. And we're over $500. So we made our $500 for the day. And we can be done trading all day if we want to. Or we can come back in a couple hours and see if there's not another trend that we can jump into. And that's just a quick little scalp off of that strategy that we talk about. And it followed through good for us this morning. Friday, it did not. Friday, it killed us. All right. So there we can look at that. In the first trade of the day, guys, we've got our $500. What are we going to do the rest of the day? Guess. All right. Class is over. See ya. No, I'm just kidding. We got options we got to go look at, right? This is options week. Actually, it's not. It is. We're going to look at options. This is our schedule. Again, I haven't got our next schedule on there. We're going to tools of the trades in not next week, but the week after. Tools of the trade. It's a really fun class because that's one where we go in and we look at software that's going to help us identify which stocks to trade at the right time. So we're going to look at different research tools because in the futures market, there's not a whole lot of All right. Sorry about that. So in the futures market, we don't really need scanners because there's, 8 or 10 markets that will trade, and that's really it. Crude oil, some of the grains, gold, silver, some of those things we can look at. Look at the Russell making a perfect little bow tie. Not perfect, but it's a little bow tie pattern. So you see this little bow tie pattern in here, up, down, up. It uses support as resistance. So that's a kind of a little bow tie. So this thing didn't quite make it up to our 16,000. It went up there and failed. So I took the profits off as it started to drop back down. That was looks like a wise decision. Just kind of starting to go snaky. All right, let's go and we're going to do some option stuff. We're going to go over and look at the options market. Let's come in here just for fun. This is always the fun part of trading. You get to come in and open up your Excel spreadsheet and come in here. See, I was down $500. Here's my notes for. Can you guys not see that? How come that's not coming up on the screen? You guys didn't see anything that came up on the screen, did you? So all the notes that I was talking about on this dumb software, I don't know what the heck's going on. You can't see my screen. Hold on a second. Give me a second. Let me do some technical setups here. All right. Can you see that? Can you see this? All right. That's better. You should be able to see that. I'm still new at this. I'm sorry. All right. This is what happened. This was our This is our 53 classes. You'd think I'd have it figured out by now. This is my notes that I put up there for Friday, and it was a bad day, right? Ugly, ugly, ugly day. Felt bad. Tried to trade the Dow while the other markets were running. The Dow was dead. I don't know why I keep trading the stupid Dow. Ugh. Ended up down over $500 before I threw in the towel. Tried to do a couple reversals looking for a continuation, then a failure reversal. Nothing played out, so ended up down. I came back at the top of the hour, traded the Christmas tree strategy, caught a nice move in the market after picking up a couple contracts, brought the account back to break even, exited the position. I had one small trade on the Russell that brought us green $60. Frustration was setting in, so I stopped for the day. At least we're green. All right, so that was what happened after hours. You can see this whole week I've been really cautious. I've been spending more of our time looking at options and playing with the options market. One of the questions was asked, are you putting your options trades onto the spreadsheet? I haven't been. I did once last month. I had a good trade that I had a President's Club come in. Charles came in with us, and he and I made a really nice day trade with some options. We did an iron condor, and it paid off nicely on the day trading. It was a day trading strategy. So this has just been my day trading stuff, not putting anything in here on options. This has just been day trading. We did that day trading, and so I stuck that on there once one of these weeks back here. I can't remember which one. But you can see my goal hasn't been met. This is the first time I've met my goal. Oh, right there. Oh, we got to put our number in there. Where are we at? 525. 525. So we got to keep our running total. We'll come in here and add our note. New note, so you guys can see how to do this. And then I just come in and I say, great morning. Caught the very first ABCD pattern breakout on the NASDAQ with 2 contracts. Paid off nicely, putting us over our daily goal. There we go. Nothing else to say about that one. Just did the right thing and away it went. Okay, let's bring that down. So I get another green check. No. Oh, $587 is our goal, and we got $525. Does that mean I have to go back and try and win it back? Do another trade, try and get up over 587 so I can get a green check? No. 525 is close enough. All right. This is horseshoes. Okay, so we got to come in here and we got to make that green. So we got another green day, but it's not a gold day, so we can't make it a dark. Oh, it's over $500 though, so we got to make it dark. It's a darker color. It's not our biggest winning day though. How about that? We got, oh, wait a second. Oh, that's our biggest greening day. That's why that one's dark green. And we've had a lot of small days, but that's okay. That's okay. It's been a quiet month for us. We've been looking at options and not spending so much time day trading. So that's my spreadsheet. If you guys, oh, look at this. It's starting to move again. The Dow's even going. Oh, good thing we took out of the NASDAQ. NASDAQ's dead. NASDAQ's not doing any good thing. Good thing we didn't sit there and hang on to it. Oh, look at the Russell starting to break higher. There's our signal over here on the S&P right there. Because we got the red arrow, right? The red arrow was up. Don't take that one. No. Take that one. Yes. Same thing here. We got red arrow. So don't take that one. No. Take that one. Yes. Take that one. No. Take that one. Yes. So red arrow, take this one. No. Take that one. Yes. Red arrow down, take this yellow arrow up. No. Red arrow up. Yes. Take the next yellow arrow up. Yes. It's just a game of yes and no. Yes. No. Of course, we also want to use our minds too, our brains. Just because we got arrows on the screen says that the market's bullish or bearish doesn't necessarily mean that's what we want to do. We also want to be mindful of the different trends and how we count them. Generally, we have 3 drive patterns, Elliott waves, Fibonacci. Those types of mathematical models come into play. We have to be conscious of those things. And if you're not familiar with that type of stuff, this is the manual to the class. Again, those of you who are in the university class, this is in your portal, and you have access to that as a PDF. If you want the paper version, you can get the manual to the class on Amazon. Just search Lan H. Turner, and that book will come up. It's 230 pages, and it's the manual to this class. It's what we're teaching in this class, all right? Teaches you how to read the charts and read the markets. All right, I do have more. I have a Sunday school lesson for you today. Plus, I want to talk a little bit about Delta and options, but I want to come and say hi to everybody first. All right, we got Matt Baker in the house. Good morning, Land. It's Thanksgiving week, usually pretty slow, or can be there some opportunities? Yeah, usually the consensus is that the markets are slow this week, but picking $500 out of the market, should be something we should still, as small scalpers and day traders, we should be able to do. So it'll probably be a little slow. We'll watch the news. There's going to be some news. The Fed's speaking today, and so that'll probably move the market around a little bit. But yeah, you are right, Matt. It is generally a slow week. People generally take the week off. It's hard for traders though, because we're addicted to this thing, and it's hard for us not to come and do a little bit of trading. All right. Plus, a lot of them go on vacation, Matt. And as we talked last week, I'm one of those guys that doesn't like to trade on vacation. And there's a lot of guys like me don't like to trade on vacation. So I know there's a lot of guys that do, but when they do, they'll do just a small amount of trading. They're not going to get real aggressive. And if those big boys, those are the guys who are moving the markets around, right? Those are the guys that are going back and moving the markets around. A lot of those guys take the whole week off on vacation as well. So Matt's right in that sense. This is generally a pretty quiet week. Good morning, Bruce. Nice to see you. Selena, nice to have you. Love to have you guys all here. We got G Wiz. Here we go. Happy short trading week to all. G Wiz has his biases set to the short side. We'll watch for some short positions then, because these markets really are kind of topping out, aren't they, on the longer term trends? So we'll have to look and see. Gary Thomas, good morning, all. Great to see you, Gary. We got Steve Scott. Steve Scott's in the house. Steve Scott's one of our President's Club members. Nice to have you, Steve. Oliver Orman. At the moment, the bond yields are rising, which is usually negative for the NQ. Yep. And it's slowed right down, hasn't it? We got a little long position on that break, but it's died right now, hasn't it, Oliver? And then B. Taylor, good morning, Land and everyone. Nice to see you. We got Kurt Schwartz in here. Good morning, folks. Great to have you. Rock Steiner. Good to see you, Rock. Glad you made it. John Mackey. Good to see you, John. I'm glad you still come. John's up in Canada, has a little struggle trading these markets because of the Canadian rules and regulations. You got to protect you against yourself. That's what the government does, right? John, got to keep you safe. And then we got Larry McIntosh. Good to see you, Larry. Glad you made it. Hope you had a good weekend. And Larry is part of our Dixie class as well. So nice to have you guys. Great to see you all here. 7:30 in the morning. Get up, watch the ponies run. And now it looks like it's pretty quiet. So they cleared out all the sales. They cleared out all the buyers, matched them all up. And now the markets are kind of a little bit quiet. Like Matt said, they're going to be a little quiet, waiting for the Fed to speak. So when I pulled that up before, I doubt you guys could see it because my screen wasn't set up correctly. So this is the news. So back to seeing the news. Chairman Fed national activity was at 6:30. 8 o'clock, we got existing home sales coming in. So that was, 8 o'clock's over. 8:05. What's the existing home? It's not red. It's not in red. So it's a second impact. It's not a third impact. We're getting a little triangle wedge formation break right here. There's our little buy signal right there. If it breaks and holds above that, that would be a continuation of the uptrend, but we've got to see a hold above that on the Dow. So you want to try and interpret that? Oh, they haven't given us why is this? I don't know. They haven't given us the numbers yet. And it's past the time, 8 o'clock. It's 8:05. Why haven't the numbers come in? Am I on the wrong UTC again? Is it UTC 6? That would put it in at 9 o'clock. I don't know. I thought I was on the wrong UTC. I thought I was UTC 6. And then that other one came in at the wrong time. We talked about this. Who was it? Was it Rock? Was it you that was telling me that I was actually UTC 7? I don't know if I'm on 7 or 6. Maybe we have to go ask Siri. Hey Siri, what time zone am I on? UTC 5 or 6? I'm a pilot. I should know this. I should just look at my pilot software. Yeah, whatever. We got our money. Okay, we got a break above, and it's holding above that previous high. So that's a bullish indication of a continuation of the uptrend. We're getting the same thing down here on the Russell. We're getting a little bit of a break. Is it going to follow? Is it going to continue? Is it going to rally? We got a first up. So there's our first up right there. We got green, green, green. We got a red arrow looking for it to, and it's staying above that green dots. I know I've really loosened the green dots up on the Russell. It's set at 1 and 1.5. So those green dots are pretty loose. Okay, here goes the NASDAQ. It's trying to break below those green dots. We're still in the red arrow. Okay, still have a red arrow down here. We've got green, yellow arrow here. We're getting a switch over here. Let's see what happens there. Actually, I want to go look at options. We got this handled over here. This is handled. Let's go look at some options. What have I got for you? Did you guys see this? I don't know if you saw this either. Maybe this didn't show up. But this is our week starting November 20th. That's this week, right? Man, I can't even remember the date. Yep, today's 20. So today's supposed to be day trading. We start off with day trading. I always start off with day trading. This says day trading, stock investing, options trading. But we're going to just kind of meld them all together at this point, right? All the classes are over, except for our tools for traders class. We're going to go and do our tools for traders. So we're going to figure out next Monday. I think it's next Monday. Our class starts on tools for traders, different tools for the markets, how to decide what is the right stock for the right time. So the software we're using, just so you all know, is Track and Trade. A lot of people ask that, and I keep forgetting to tell people. The software I use is Track and Trade, Stocks and Commodities Annual Reader's Choice Award, 6 times, actually 7 times. That's an old graphic. So we've actually won it one more time since this picture was created. So this is 6 times, and it's actually 7 times. Oliver's saying, let's go look at the metals. You want to look at the metals on the stock market or in the futures market? I am a futures lover, so let's go look at the metals. John Oliver wants to look at gold and silver. I think that's a good idea before we go jumping into the stock market and looking at options. Plus, I got a Sunday school lesson for you today, so stick around for the Sunday school lesson. I always have a nice little Sunday school lesson. Oh, let's just go look up here. I got them all set up already. Where's my portfolio of gold and silver? Gold and silver daily. Let's look at them from a daily standpoint. And there's where we got our one up for every down. We've drawn all of our little one ups for every downs in there. So there's gold. So gold's on the left, silver's on the right. And what have we got? So we're in the up right now, but we're getting lower highs. So the bar's pulling back. It just broke. Let's zoom. So we're actually getting a break. Okay, it hit the blue. That's the Elliott wave Fibonacci calculation. So it hit that blue Fibonacci calculation right there. And now it's backing off. So on the daily chart, we're getting lower highs. And on the daily chart on silver, we're getting lower highs. So we just broke the lows to that uptrend. Now, could it just be a little tiny pullback, giving us a little bit of a flag formation in here? Generally, for a flag formation, we want to see higher highs. The highs remain and the lows are the ones that break, not the lows. We don't like to see the lows break. Not that it can, it certainly can. It can come down and make a little bit stronger reversal and then the next leg up. And that might be what's going to happen here. Or it could just be on the way down, right? Because this is on the way down. So we got down, ABC. It could just be coming down off of this peak. We are down in the lower region. Stochastics is curled on us. But that's kind of what we're looking at on the daily chart. Just snaky. Let's go look at the 1 minute chart and see if there's any day trading opportunities. Oh, look at that. Oh, wow. Very beautiful, man. I know that old Mark Peterson's like, why don't you come and look at these markets more often? Mark, of course, is my trading buddy. Known Mark for almost 30 years. He and I have been buddies. And he likes to trade these other markets more than the indexes. He's like, the indexes are like trading the Indianapolis 500. Why don't you come over here to the gold cart track and race around on a different market once in a while? It's not quite so aggressive as those morning bell markets. And that's why he likes to trade some of these other markets. A little bit gentler, a little bit quieter, takes a little bit longer to wait for a trend. You have to have more patience. You know me, I struggle with patience, especially when I got a group of people watching me. Hey, Oliver says he's got his future account with Track and Trade. That's great to hear, Oliver. So Oliver's asking a little bit about Forex. We do have a Forex version. I don't talk a lot about it because I'm so in love with futures. Doesn't mean you can't trade the Forex market. You certainly can. Track and Trade has a Forex version. We just don't talk about it a lot because we're so in love with the other markets. But let me see. I'm going to try and pull it up here off screen. Nope, it's got to get me I was going to pull that up for a second, but I'll have to do that. I got to get my username and password put back in there. I'll do that. I'll try and pull up Forex for us tomorrow. How's that, Oliver? I have only a futures account with you. That's all right. That's okay. Futures is where it's at, man. That's where it's at. Look at this. Trying to just watch the gold and silver a little bit for a minute here before we jump over and start doing our options lesson. I know the guys that are in class here from the options class are anxious and excited to get to the options side of things because of what we learned on Friday, and they want to see us talk a little bit more about that. We'll get there. Just I'm so intrigued with what's going on in the opening bell. You know, I like to watch these things. So we got one up for every down, and chart overlay, bulls and bears. So there's our arrow, bulls and bears. Chart overlay. This other one is the what do we got on over here? Oh, that's just the MACD, I think. Nope, not MACD. Oh, it's DMI. We don't need that. All right, that's just confusing. Okay, back to our charts. So we're getting a little bit of a quiet market here on gold. It's getting ready to break. First green candle to make a new high after this little flag formation. So kind of drag that in there a little bit. We're looking for gold to come up and test that VWAP. So that's our goal for the day. Break this high. Maintain that uptrend. Bullish move. Break the first green candle to break a new high after that little trend right there. So there's our buy signal. I'd like to see a hold up there. We got 2 seconds. Is it going to be green? It is. It's green. Wait for the pullback. Get in. Go long right there. Put your stop. You can put your stop 1 bar back. You can put your stop on the yellow dots, or you can put your stops behind the low of the pullback trend. Whatever works for you, whatever you feel most comfortable with. I'm a little bit more aggressive. I like to put mine up there 1 price bar back, because if it doesn't immediately go, if it breaks and comes back and breaks the low, well, it's no longer in an uptrend, right? Uptrends are higher highs and higher lows. But oftentimes, because you get aggressive on the breakout, it comes right back down, touches your order, stops you out, and then continues to rally. So sometimes it might be better to be on the yellow dots, give it just a little bit more room. And sometimes it comes down, spikes those yellow dots, and then turns and rallies and goes back up. And then sometimes, so that's why you put it down here below the low of the downtrend. But then it comes down and spikes that one out, and then you get stopped out with all 3 orders. Bam, bam, bam. Which is better, Lan? Which is better? Well, I always err on the side of caution and put my stops really close in case the market doesn't follow through, comes down and flushes me out. Now, right here, this is a perfect example of that. If we'd have been right here, if we'd have got in on that break above, we'd have got stopped out 1 price bar back right here. We'd been out of this market already. But if we put it on the yellow dots, we'd be out of this market already. But if we'd have put it down here on a break below this low right here, we'd still be in the market. Our stop would be down here. We'd still be in the market. See how it come down and tested that low, and now it's starting to rally again? Now it could take off and run. It's just, that's the name of the game. What's the right answer, Land? What's the right answer? There is no right answer. It's just a different answer. You're going to get a different result on different things. I err on the side of caution. I get stopped out a lot on small, little tiny losses, and then oftentimes have the market take off and run in my favor. But I can always get back in again. You see me do that once in a while. That's just how I think about the market. You can think about the market however you want, but that's how I like to think about the market. Okay. All right. So there's gold and silver for us, Oliver. Wanted to go see gold and silver, and that's what's going on. It's a little bit dead right here. It's not really doing anything for us. That's an A1 breakout. I always say don't chase the A1s. You want it to give us about 4 good solid bars, giving us a positive and, a little good positive move like it did here. So that's kind of sad to see it fail here on the rally. Let's see if this one can go. But it did pull back just to knock everybody out, just to be mean, because it could. There it goes. All right, let's go look at our options. It's going on the second break. All right, there's FNGU. FNGU. Let's pull this up so we can see what's going on down here. We're going to go look at just review our orders, the ones that we put on. This is our Apple position, right? Let's just come in here. We'll go all open position. Now, I learned something because Friday we were having a hard time seeing this. Now, I went and Microsoft has this feature called accessibility, and you can turn up the fonts. Let's see if this helps. Because you guys were saying you couldn't see these fonts down here. So we're going to go to multiple chart only, and then I'm going to make those fonts. Hold on. It's doing its thing. Look at how big those fonts are now. Can you see those better? Can you see those better? All right. Hopefully that's a little bit better. All right. Hopefully that you can see that. I asked the programmers if I could change the colors of these green text down here and make them different. They said you can change the whole. I can come in here and go to view, and I can come down here to color theme, and I can change this color theme to traditional or light, and it'll turn everything white instead of this really pretty black color. So so there is that, but I don't want to do that. I like this black color. It's really sexy. So I just tried to make the fonts bigger. Maybe you guys can see that a little better. It's not on my screen. It looks awful, but I'm sure it shows better on the YouTube. The white is good, but the green is still hard to see. Is it still too small? I can try and make it bigger. Hey, hold on. Watch everything freak out as I make it bigger. There, I made it bigger. Is that even better? Can you see it now? Hopefully you can see it. If I have to switch all my colors over and just go to a white background with black text, we can do that. But this is such a sexy color. I love the black. It's easier on my eyes. I like it better. All right, let's come in and take a look at what's going on. These markets are still rallying. We got in on the at the money, the in the money, the out of the money, and the far out of the money options. So let's just review them very quickly. Again, this is not an options strategy other than just buying some calls. All right, we just bought some calls to see what they do. It's just for comparison. Okay, so we got our cost basis in here. All of them combined are 2,929. Each one individually. This one we paid $870 for. That's the 185 call. The 185 call is no, it's not. Oh yes, it is the one. Yeah, 185 call. Okay, let's start down here. Let's start with the 175 call. The 175 call. That's the one that's deep in the money. All right. So the deep in the money And you'll notice that I caught in here in track and trade. You can turn on, I'm going to right click and show you. You can right click on the header, and you get all kinds of neat little things you can see in here. But this column chooser down here is loaded with bear, loaded for bear, lots of stuff, all kinds of things in there. Notice I have, excuse me, I have most of them turned off, right? Most of them are turned off, but you can go turn those on. You can read the instructions. You can go to the help menu. You can see what all those are, but they're pretty self-explanatory once you read the description. But I have most of them turned off, but the most important ones turned on here. Okay, so that's what we got going. I could probably turn off that order ID. Does it let me? Oh, it won't let me turn that one off. Okay, so we've got in here all kinds of neat stuff. So we got the order ID, the symbol, the name of the stock, the date that we open the position, days until expiration, whether it's a put or a call, the quantity, the current price, the cost that we paid for it, the current value, what it's trading for now, the delta. Delta is what we're going to talk about today. Used margin, whether we use margins or not, the intrinsic value and the extrinsic value. That's what I want to show you I turned on. I turned on the intrinsic value and the extrinsic value in that menu so you can see the difference between the two. And then we got the gain, and then we've got the gain, or the gain percent, the gain total, and the total gain. All right, so we've got in here intrinsic value and extrinsic value. Now remember, each option is made up of two different kinds of value. Intrinsic value, which is the value that is between where you got into the market and where it's currently trading. So that's your intrinsic value. In this case, we got in at the money. Remember, at the money right there. So that's where the market was trading when we put it on. So that's why we call it at the money. The in the money was down here, meaning that it had already, the day we bought it, it already had a whole bunch of intrinsic value. Intrinsic value, again, from where the option was trading when you bought it, or where you bought the option, to where the market is trading. So that one had $1,000 of intrinsic value built into it the day we bought it. So you have to ask yourself, why would you do that? And I'm going to show you here because we're going to talk about delta. We're going to go in and have another little lesson on delta. On class on Friday, we talked about delta. Or was that Thursday? We might have talked about delta on Wednesday. I can't remember. We talked about delta in class. We're going to discuss that here in greater detail here. We'll show you some delta examples. All right. And then this is the at the money, and then we have the out of the money. So the out of the money options don't have any intrinsic value at all. There is no intrinsic value. It only has extrinsic value. And the extrinsic value, again, is time value, how much time until options expire. And you can see that right here on the screen. The options expire at that purple line. So you have that purple line drawn on the screen. That's when your options expire. And if they're out of the money, above where the current market is trading, in the case of a call option, then that means that there's no intrinsic value, and the only value that's in that option is extrinsic value, or what I call opportunity value. Okay. So it's time value that's in there. So that's the two different kinds of values that make up an option. So you look at an option that's not in the money, there is no intrinsic value. You're like, well, why does it have any value at all? It's worthless. I mean, why would I buy in this case, Apple stock why would I want an option to buy it at 195 when I can just go buy it at 190? I can buy it cheaper than what the option has. Well, because the option has time value. And if the market starts to continue to rise, in this case, if the market continues to rise, then that option's time value, that opportunity value, will continue to rise. And so if you remember, we want to think in our minds that our investment into Apple is the premium that we pay for the option. When you buy an option, that is your investment in Apple. Now, it gives you the right, but not the obligation to buy the underlying stock. But if we exercised our right to buy that stock, we'd have to pay $19,000 to get into that stock. And we don't really want to do that. Don't want to pay $19,000 to buy 100 shares. Well, I just buy less shares, Lan. Well, you can, but an option gives you the right, but not the obligation to buy 100 shares. You can't buy an option for only 20 shares. They don't let you. That would be really cool if they did. I would like that a lot, but they don't. 100 is the smallest increment that you can buy. So now what we have is a $325 investment in an out of the money option. And that's what this option here is, which is the 195 call. All right. There is no intrinsic value. It's only got time value. That's why it's less value. That's why it costs less money than one that's in the money or at the money, because it has greater opportunity for profit at expiration. And so that's why it's more expensive. And it might also this one down here, the reason it was very expensive because it already had some built-in and intrinsic value. Now, if we come out here and look at the one that's way out here, this is one that was far out of the money. Now, it didn't cost us very much because the likelihood of it being in the money at expiration is pretty low. Not a big expectation there that thing at expiration is going to be in the money. But if the market continues to move in the favor, which is, if you buy a call, you want the market to go up. And if it does, when you buy that call, even if you buy a very far out of the money option, it's going to still continue to rise in value. So our investment into the market on this one that was very far out of the money was $100, right? We paid, that's the current value. Cost value was $79. So we paid $79 and it's currently worth $100. Well, that's pretty cool. We made 20 bucks. All right. We made 20 bucks. In fact, we made $21. But the gain on it, look at the gain. It's 26.54%. It's the highest percent gain. That's because you took a bigger risk. Bigger risk, bigger reward. But it's a smaller cost. Okay, so it's a smaller dollar amount, but it's a bigger percentage. Now remember, like I said before, a lot of guys, we've made, look at this, overall, on all four of these options combined, we've made 15, almost 16% return in 4 days. So on the far out of the money, we made 25. On the out of the money, we made 24. And on the at the money, we made 18. And on the in the money, we made 12. Okay, so those are percentages that some people would wait a year or even 2 years to try to obtain, right? So that's what is so great about trading options is that you have high leverage. But anytime you can make money fast, you can also lose money fast. The great thing about options, though, is the maximum amount of money you can lose is the premium you paid for the option. So if you bought that $79 call and it didn't go up 25% for you in that short period of time, if the market didn't just kind of explosively continue in your favor, the maximum amount of money you would lose is the $79. But you got to be careful. If the market doesn't kind of move aggressively in your favor, that market, that $79 will disappear pretty fast. So a lot of people will say, well, I'll just buy, 100 of those $79 call options and I'll be rich, rich, rich beyond my wildest dreams because I'm making 25% return. Okay, do that. Not going to tell you not to, because that's a strategy that a lot of people like to do. But just remember that at expiration, the opportunity, the chance of that being in the money is pretty low. So you're going to want to take your profits quick on it. All right. It's going to be more of a quick return, get in, get out of the market, take your profits, and away you go. And make sure you do your due diligence. Make sure you're doing your technical analysis. A lot of people forget that the reason options increase or decrease in value is based on the movement of the underlying market. And so we want to time our entries. We want to be very good at timing our entries on these options. If we're not getting in on the exact break times or when the markets are really getting ready to explode and burst for us, we can lose money on options. And remember, an option can still lose money even though you pick the right direction. You might buy a call option and it has that time value in there. And if that time value decays faster than the market's moving in your favor, then you can be right and still lose money, because every day an option's march towards its death continues. All right. You lose time value every day, and that's part of your extrinsic value. And that decays every single day. And so you have to have the market move in your favor and make enough money to outperform time decay, plus give you that profit. All right. So that's where we're at there. Let's go in and I want to talk about delta. Delta is very important. So I'm going to come in here. We have the delta column in here. And I want to kind of explain to you, if somebody was, on their game right now, and I'm going to delete all of our drawing tools. Somebody was on their game and they come in here and they said, Lan, I saw you draw a dollar calculator from where you got in with that at the money option up to where the market's currently trading. And that shows $567 of intrinsic value. That's how far that market's moved for 100 shares. But then when I look down here at your option, which is sitting at 100, the 185 call, which is this top one right here, you say that your intrinsic value is 575, your extrinsic value is 441, current value is $1,000, cost basis was 870. Is that the one that we're looking at? Yeah, that's the 185. $570 of intrinsic value, but my gain is only $147.50. Why am I not up $567? What is wrong with this? How come I'm not showing a profit of $567? I bought the call. The market is currently trading at 190. You draw your dollar calculator on the screen. Make this a little bigger so you can see it maybe. Is that helpful? You can see right in here $567 of intrinsic value. It says intrinsic value $585. Why is my gain only $155? Why have I only made $155? Because of delta. All right. Delta is something that we have to work into the mathematical model or the creation of these options price models. And if you'll notice that delta is currently sitting at 68.68. All right. So 0.68 means that we're only profiting 0.68 for every dollar that the market moves in our favor. Now, delta, when you buy an option at the money, now this is kind of gets a little crazy here. Just stick with me. But when you buy an option at the money, it has a delta of 0.50, okay, because it's at an equilibrium. And a delta of 1.0 would be as if we traded the stock itself. So if you bought the stock, you have a delta of 1.0, one for one. Your shares are going to increase $1 for every dollar move in the market. Makes sense, right? You spend $1, the market moves $1, you make $1. So it's 1 to 1. But an option doesn't work like that. An option has a delta. And at the beginning, when you first buy the option, you have to look at the delta's value, because the delta is what tells you basically how many pennies you're going to make for every dollar that the market moves. And when you buy an at the money option, the delta is usually right around 50 cents. So an option is only valued at zero intrinsic value, zero extrinsic. An at the money option is valued at zero intrinsic value, but its extrinsic value is time value, is the only value it has in it. So it starts it at 50, right? 50% of the value is time value, 50% of the value is the probability of extrinsic value, which you have zero. Therefore, you only get 50% of the value of the option. Does that make sense? That's a nice way to think about it. So if you come in and we go to our calls only table and we look out here 60 days and we look at our options, you can see in here that we have an at the money option right now is a 190. So the market is trading at 190. So an at the money option, if you come over to our delta table, which is out here, you can see delta on the 190 is trading at 0.58. Okay, so 190, it must be trading a couple pennies above, which it is. It's trading at 190.90. So it's got $1 of intrinsic value. That's why it's not 50. So think about it like that. When you buy an option at the money, exactly at the money, there's no intrinsic value. So you don't get any intrinsic value on the delta side. Okay, so you're only getting half your value. Okay, does that make sense? So you're starting off at 50 at the money. So if it increases in value, your delta will go up. You'll start making more money for each dollar that you make. So if you look at an option that's further in the money, let's do one that's further in the money right here. You can see as you go down the scale, these are further in the money. That one's got a delta of 0.68. So that means it's making 68 cents for every dollar that the underlying stock moves. Here's a delta of 0.76. Here's a delta of 0.81. So our out of the money option has a higher delta. And that would be the reason why you would buy an in the money option. If you buy an in the money option, you are more likely to have a higher delta. And that higher delta means that you are making more money per dollar invested than you are than you would if you had an out of the money that had a very low delta. So you have, in this case, our deep in the money option, which is this one right here, this deep in the money, has a delta of 81 or 81 cents. So 81 cents for every dollar that the underlying stock moves, our option will increase or decrease in value by 81 cents. Now that changes as the market moves. You see, it was 81, now it's at 80. So those deltas will continue to move and rise as fall as the market moves towards expiration. Okay, so that's what delta is. Let me see, I'm going to put myself up here. Get myself out of the way. There. So that's what delta is. Delta kind of like is the profit potential or the dollar amount, penny amount of how much money you're making per dollar move. Now there's an easier way to think about it. Rather than saying, well, I'm making 68 cents for every dollar the underlying market moves, just think about it like this. Each option represents 100 shares, right? So all we have to do is look at delta and we can say, well, I have a delta of 0.58. Okay, well, that means you're making the same amount of money as if you owned 58 shares. How's that? That makes it easy, right? So if you have a delta of 81, you're making the same amount of money as if you had 81 shares. Or you're making the same amount of money in this option as if we have 19 shares. Now it's money, it's not percentage. Okay, so this is just based on dollar amounts. So if we come over here and look in our closed options or our positions, you'll notice that it's based on dollar amounts over here. This is your delta, that we have a delta of 81, which means we're making 80, it keeps moving between 80 and 81, but we have a delta of 81, meaning we're making or losing as much money as if we had 81 shares. Dollar amounts, okay, 81 shares. Now, the same down here is 68, so we're making it as 68. So we're making and losing the same as if we're making a dollar amount of as if we had 68 shares. Now, I want to tell you something else that's really cool about delta. And I didn't have a chance to tell you guys about this. Bruce is saying that he's still having a hard time seeing those numbers. He says it's not the size of the font, it's the black background. Can I try something? It might blow things up, so give me a second. Let me try and fix it for you, Bruce. The programmers gave me another solution, but whenever I do it, it might mess things up. Okay, hold on a second. Here we go. I'm going to put this back to normal. And then I'm going to come in here, save this, file. We're going to come down to color theme, and I'm going to go to application color theme, and I'm just going to say light. It says I have to shut the system down. I guess while this brings it up, go back over to our options chain, or our positions, open positions, chart, multi-leg, chart. Oh, we got to go to Apple. All right. Is that better? How's that? Tell me that's a little better. Do you still need the font to be bigger now? Let me know if that's better. We'll work with that for a minute. If we need to make the font bigger, we can still make the font bigger as well. So let's just do it while we're here. We'll come it up and make that font just a little bigger. Maybe we can make it even a little bigger than that. I'm using it always scares me when it does that. I think it's going to explode. Okay, let's try that. See if you guys can see that a little bit better. Turn all this software white. Okay, so it seems awful bright on my eyes. Okay, so now we're back here looking at the delta. So the delta, again, that we're making the same amount of money as if we had 80 shares. This option is making the same amount of money as if we have 18 shares. This one is making the same amount of money as if we have 44 shares. And this one is making the same amount of money as if we have 68 shares. And it all depends on where we put it in relationship to the current market price when we bought the option. Okay, very cool. So that's how that works. That's how delta works. All right. Now, one more thing I want to teach you about delta. And tomorrow we're going to teach you about the Black-Scholes and the Greeks. So make sure you come to tomorrow's class. Very important to learn about the Greeks. It's going to be the most important thing I can teach you. You got to know about the Greeks. It's got to be here for tomorrow's class because I'm running out of time. I'm teaching about delta today, but I want to teach you one more thing about delta. If we right click on the top, we come to column chooser, slide down here to probabilities. I want to talk to you about probabilities of the markets based on delta, but we have probability calculators in here. If I can find them. Current premium position. Where's my probabilities? Rate, current premium, cost, settlement, same day, day change, intrinsic, extrinsic. I'm going to turn those off for right now. Options, position, theta, return on capital gain. Oh, I'm on the wrong table. I'm on the wrong table. Let's come over. It's got to be in the options chain. That's where I want to be. Oh, and they're already turned on. Okay, here we are. So I want to teach you about the probabilities, okay, of an option. So let's go back out here to our 60-day calls. And I want to show you the probabilities of being in the money and out of the money, okay? So see this table right here? Probabilities of being in the money. So that's a really cool table. It tells you what the probabilities are that this thing is going to be in the money at expiration. It's a mathematical model calculated based on delta that tells you, hey, if you buy this at the money option, you're going to have basically a 57% chance that this market's going to be in the money at expiration. Now, if you go a long ways out of the money, you'll notice that your probability becomes a lot less. So if we come out here to this option that we bought that was way out of the money, our far out of the money 205 call option, well, it has a probability of being in the money of 18% and a probability of being out of the money of 82%. So when you take a bigger risk, you get a bigger reward, which is why your percent increase is greater on this option that's way out of the money. Okay, so you can see that it's at 20% profit. This one's at 20.77. This one's at 15, and this one's at 10. The 10, the reason you are making a less percent gain is because you're making more dollar amount. Your delta is higher, right? Your delta was 0.80, so you're making as much money on an 80 as if you had 80 shares. That's why you buy in the money options. You get a higher delta. You're making money as if you have a larger number of shares. Your delta is higher, but your risk is way lower. So they don't pay you as high of of a percent return because your risk is so much more safe. It's more secure. So if you come down to your probabilities, see, we have an 80% chance of that option being in the money. That's what probability in the money means, ITM. So we have an 80% chance of being in the money, which is why we only make an 11% return. Whereas up here, where we have a high percent return, 21% return, our probabilities of being in the money are only 18%. So you take a bigger risk, you get a bigger reward. Now, that's at expiration, okay? At expiration, that's what that's calculated on. Now, this other table right here, the other column is probabilities of being out of the money. So you can look at it, and it's just the opposite. If you got an 18% probability of being in the money, you have an 81% chance of being out of the money. Okay, so those are your probabilities. So that's pretty cool, right? If you come in here and you have a more intrinsic value, you're going to have a higher probability of success or higher probability of being in the money at expiration. Doesn't necessarily mean it's a higher probability of success. They're all going to have basically the higher probability of success. The market could fall. You could still be in the money, but you would have lost money because you had to buy a bunch of intrinsic value to get that higher delta and get that higher probability of being in the money. But you could still lose money, right? Because you could lose part of your intrinsic value, still be in the money, but have lost money and have a higher probability. That's just how it works. That's how options work. You can have a high probability of being right, but still lose money, okay? Because you bought intrinsic value and you could lose some of that intrinsic value, which is why I don't like to buy intrinsic value. There's very few cases that I'll buy intrinsic value. I like to buy at the money most often, or a little bit. I might buy a penny or two in the money just to get a little stability right there. But then I like to buy out of the money or at the money options. That's what I like to buy. I like to get that because they're all going to make or lose money based on the underlying movement of the market. And the out of the monies are going to have a bigger percent return. So why spend a whole bunch of money buying intrinsic value when you could just lose it? So That's why I'm not a real fan of buying intrinsic value. There's lots of guys out there that'll teach you to buy intrinsic value. Oh, buy deep in the money options. They're wonderful. They're great. But when you think about it, there's really no advantage to it. Not a lot. I know there's some strategies that use it. So you don't want to never say never. But for me, if I'm just going to buy an option, I'll buy an at the money or a little bit out of the money or just a touch in the money if I feel like the market needs a little bit of stability. Okay. So that is our probabilities. And I wanted to show you how that relates to delta. So if you come over here and look at your delta, okay, if you look at delta, in this option, let's say the one that's deep in the money has a delta of 0.80. Look how it corresponds to your probability. Your probability of being in the money is 80%. So if you have a delta of 0.80, your probabilities of being in the money are going to be pretty close to 80%. If you have a delta, notice you have a delta of 18, well, that means that your probabilities of being in the money are going to be pretty close to 18%. So those numbers kind of correspond with each other. And so delta is also a probability number, but it also tells you how much money you're making per share. So, you're making 18 cents per share, dollar amount, but you can make a higher percent. It's a higher gain. The percent is a larger gain because you have a smaller investment. All right. All right, guys, that is our options class. Now, I want to give you my Sunday school lesson. I promised you a quick little Sunday school lesson. So before we log off, we're going to do a Sunday school lesson. And I do need to remind you, come on tomorrow, because tomorrow we're going to talk about one of the most important things I can teach you when it comes to options. It's got to be the single most important thing. If you miss it, you got to go watch the recording. And if you miss that, you won't know what the hell you're doing when it comes to options. You got to watch tomorrow's class. All right, but we're going to have a Sunday school lesson right now. All right, here we go. Plan your trade and trade your plan. Don't swing for the fences. This causes horrible losses, turns winners into losers, causes inconsistent results. This is a marathon, not a sprint. Winners have a lot of base hits. Have realistic expectations. All right, so today, when we were day trading, we were over there looking at the day trading market, which we have to go back and look at. We can't log off without going back and looking at our day trading market. Oh, look, gold just did nothing. Dead gold, dead silver. Let's go look at our indexes. What are they doing? Got to look at the indexes before you go home, before you get off, before you go home. One up for every down, one up for every down. We're in the up. We're looking like we're getting ready to do a down, but that is a flag formation. If you are confident in this market, well, just notice what we got going here on the Dow. We got the red arrow here. Buy, 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 buy. We got the yellow arrow here. Yes, yes, yes. Yellow arrow here. No, no, no. All right. So we're in the uptrend. We're getting a flag. Flagging formation is a continuation formation that should break and rally higher. If it breaks below that first green bar, we'd wait. If it breaks below that green dot, we throw the whole idea out of taking a long position and just watch the no, no, no arrow for a little while. All right. So there we go. All right, guys. Kirk says that that's much better on the screen for that. For my colors, maybe we'll have to go with the white on black for projection. But I love that black color. I just love this black color. Don't you guys just love the black color? All right. There we go. That white color makes it so you can easier see it. Then that's what we'll use. And there's our positions. Makes it easier on your eyes. That's what we'll use. All right, guys. That's my Sunday school lesson. Don't forget to subscribe to Pitt News Magazine. Pitt News Magazine is the way I stay in touch with you guys. It's only $1 for an entire year. You can use the coupon code LANDLIVE-$1 and get Pitt News Magazine. And we do have some wonderful articles coming out in the December issue that you're absolutely not going to want to miss. Go get your $1 subscription to Pitt News Magazine. It's loaded with all kinds of great things. You can listen to the articles, you can read the articles, and videos come out so you can watch the videos. Okay, that's it. I'll let you guys go for the day. Have a good day, and get ready for Thanksgiving. See you tomorrow for the most important options lesson in the entire class.